Hi friends, this is MP Tony, practicing chartered accountant. Today we are going to discuss 4 important topics in GST. Number 1 is about the annual return in GST, filing of GSTR 99C, and the topic number 2 is about the GST collection in our country. Topic number 3 is about one of the important question that was asked by one of my student. And lastly, I will discuss about the importance of December month. Let us go in detail. The topic number 1 is about the annual return filing. As all of us know, December is the month for filing GSTR 999C. The last date to file GSTR 999C is 31st of December. So we are now in the month of December. So make sure that you are filing this annual return before 31st of December. Another important aspect that has to be kept in mind is who is liable to file annual return. You know, every regular registered taxpayer must file the annual return. And there is a turnover limit. The turnover limit is 2 crore rupees. If the annual turnover is below 2 crore rupees, then they are not liable to file GSTR 9. And if their turnover, annual turnover is above 5 crore rupees, then they have to file GSTR 9C. So that means up to 2 crore rupees, there is no need to file any annual return. And if the turnover is above 2 crore but below 5 crore, then we have to file only GSTR 9. And if the turnover exceeds 5 crore rupees, then we have to file both GSTR 9 and 9C. Another aspect to be looked into is the turnover limit is to be calculated or determined not based on GSTN wise turnover. It is based on PAN based turnover. So sometimes what happens, a person is having 2 registration under the single PAN. So for the purpose of 999C, this 999C must be filed registration wise. So the turnover limit to be looked into is PAN based turnover. So if PAN based turnover crosses the limit, then you have to file 99C. Let us take an example. Suppose a person is having 2 registration under the same PAN. In one registration, the turnover is, suppose, let us assume 1.5 crore. In the second registration also 1.5 crore. So under the same PAN, there is a total turnover of 3 crore rupees. In this case, since the PAN based turnover has exceeded 2 crore limit, he has to file GSTR 9 for both the registrations, registration 1 and registration 2. So the point is, what is to be looked into is not the registration wise turnover, it is the PAN based turnover. So this is about the annual return. One more aspect is about late fee. See, normally people ask a question whether GSTR 9C attracts late fee if there is delay in filing 9C. Let me make it clear that there is no separate late fee for GSTR 9C. Late fee is only for GSTR 9. And GSTR 9 is treated as complete and filed only if GSTR 9C is also filed. So the point is, there is no separate late fee for GSTR 9C. Late fee is only for GSTR 9. But if there is a delay in filing GSTR 9C, you have to pay late fee up to the date of 9C for the delay in filing annual return GSTR 9. So there is no late fee for GSTR 9C, but you have to pay late fee on GSTR 9 till the date of filing 9C. So these are all about annual return. Another topic is about the GST collection. As all of us know, GST Council recommended a GST 2.0 from 22nd September 2025. So all the stakeholders, whether it is central government, state government, the public, the taxpayers, everybody was eagerly awaiting what is the impact of GST 2.0, whether it will be positive or negative. So as far as these public are concerned, they are very happy because tax rates are generally brought down, reduced. For example, automobiles like two-wheelers, all vehicles, cement, TV, fridge, all these, most of the items tax rates came down. So it is good for the public. But for the government, whether it is central or state government, they were eagerly awaiting whether this reduction in tax rate will result in more tax revenue, more collection of tax. Generally what happens, when tax rates are reduced, the direct impact is that tax revenue will come down. So when tax rates are increased, tax collection will go up. That is one side of the story. So what happened now? Tax rates are reduced. So normally tax collection will come down. But at the same time, there is another side as per which when tax rates are reduced, consumption will go up. Automatically, tax collection will also go up. So there are two sides. There will be tax reduction. The collection will come down due to rate reduction. But tax collection will again go up since consumption goes up. So net we have to consider whether there is overall tax collection increase or decrease. So, on 1st of December, 2 days back, the collection data has been published. This collection data is published on 1st of December, but all of you know that this data belongs to the month of November. So this is the tax collection in the month of November. So when taxpayers pay this tax, when the business people pay this tax paid in November actually belongs to the transactions happened in the month of October. So the October tax is collected in November and that is published on 1st of December. So this is the first full month for which data is available. If we go through this data, what we can understand is the tax revenue has not gone up. There is only a very low marginal increase. The collection is not that much, is very normal. So this is one very important aspect, that when there was a lot of festivals and there was a lot of celebration based on the rate reduction, actually governments were expecting that consumption will go up. As you know, the vehicle sales data, two-wheelers, automobiles, everything has gone up. But even with this celebration, festivals and rate reduction, the consumption may have gone up, but tax collection has not gone up. So we have to wait and watch what the governments are going to do next, whether there will be further changes in the rate if this trend continues in the subsequent months as well. We have to wait another month. We have to wait till January 1st to know how much tax we have collected in the month of December, which belongs to the month of November. So this is very important. One more point is that when government introduced the GST 2.0 in September, many people, many public would have postponed their purchase to the month of October to get the full benefit of rate reduction. So even with this additional purchase, additional consumption, the tax revenue has not gone up much. So we have to wait and watch what is going to happen in future. The third aspect is about one of the important question asked by one of my student. The question is this. He is asking whether income from lorry, running of lorry is liable for GST. That is a simple question he is asking. As you know, there will be many business people who would have many vehicles in their books. They may be getting some income from that. So people will have some doubt whether the revenue, the income is liable for GST. So this is the question. So my answer is, we cannot generally say that there is tax or there is no tax. The taxability depends on many factors. If you look minutely into this type of lorry income, you are having some lorry or vehicle, you are getting some income. We have to see what is the nature of that income. If it is transport income, it is exempted because all road transport other than GT and courier is already exempted. So if it is simply transportation, there is no GST, but you have to make sure that it is not GTA or courier. Another type of service is GTA. If it is GTA, all of you know that there is forward charge, reverse charge, many things. There is this taxable. And the other one is renting of vehicle. Similarly, you can see it is taxable. Renting is taxable. There is leasing of vehicle. That is taxable. Leasing. Another aspect is hiring of vehicle. Yes, that is also taxable. Hiring of vehicle to a GTA is exempted. But so my answer to the question is, we cannot simply say income from lorry is exempted. But what we have to do? We have to look into the minute details, whether it is transport income, whether it is GTA, whether it is renting, leasing, hiring or hiring to a GTA. The taxability varies, tax rates varies, eligibility to ITC varies. So these are all points you have to keep in mind. The last topic that I would like to share with you is about the importance of December 2025 as far as assessments are concerned. Now we are in the month of December. Officers are very, very busy now to issue orders. You know, for the purpose of issuing orders under section 74 for financial year 18-19, the last date is 31st December. So all the officers, whether it is central GST or state GST, they are very busy with preparing orders for financial year 18-19. This is for orders under 74. And similarly, you know, for financial year 21-22, officers are busy passing orders under section 73. So, and the last date is 31st December. So for the month of December, we have to be very careful. Officers are busy, they are passing orders. Time limit is 31st March, whether it is for 73 or 74. 73, it is 21-22 financial year. For 74, it is 18-19 financial year. So you have to be very careful. You track the notice. You would have already received the notice and you would have filed a reply and attended personal hearing. So you have to be very careful to go through the portal, and whether there is any order, take appropriate action. If you are ready to pay it within time so that you can get the benefit of reduced penalty. If you are getting order under section 74, penalty can be reduced to 50% if you pay the tax within 30 days from the date of the communication of the order. So you have to take action immediately. Or if you are not ready to pay, if you want to file an appeal, yes, you can file appeal within 3 months and a maximum condonation period of 1 month. So this is all about for today. We will see you in another video. Hope you have enjoyed watching this video. Thank you for watching. Thank you.